Reserve Bank monetary policy is due on August 10, and this time tomatoes are likely to hijack the policy. As always, CNBC TV18 Citizens Monetary Policy Committee meets ahead of the RBI MPC to discuss what should the rate policy be. Joining me now are Sajid Chinoy of JP Morgan, Soumyakanti Ghosh of SBI, Shamiran Chakrabarti of Citi, Sonal Verma of Nomura, and our chairman, Dr. Pranab Sen, joining us from New Delhi. Gentlemen and Sonal, thank you very much indeed. Well, you know, tomatoes will figure in the discussion. So, Shamiran, let me start with you on that. Our poll threw up a number of 9% food inflation for July and maybe 6.5 or 6.6 for headline. How worried should we be about food inflation in general?
So, Latha, I mean, obviously, tomato prices are it's in everybody's mind, but at least across the vegetable basket, the 11 vegetables that we can track, there has been a significant increase for all of them.
Oh.
So it's a generalized vegetable price inflation. We have, on a month-on-month basis, the vegetable price inflation could be 35–40% as well. So, and because it's not showing up as much in onions and potatoes, a little bit there as well, probably we're not discussing it enough. But the good news is that beyond vegetables, the rest of the food index is still doing reasonably okay. And it has not yet passed on to the non-food core part of the index.
There was a scare on rice and pulses, no?
I mean, there is a very small increase, but it's more the narrative which is worrying on rice, edible oil, etc., where going forward there could be price pressures, but at least for this month's data, that's not really the scary part. And there is the disinflation process on the core, which is continuing as a part of even global trend. So altogether, we think around 6.8 type of a number is possible headline for July. But the key question is that how long would these prices stay elevated, and would there be at all any impact on inflation expectations, etc., which generally are sensitive to things like vegetable prices.
Will RBI raise its inflation forecast for the full year?
It is mechanically they will have to raise the number because if you have 2–3 months of much more elevated print, then the average will obviously go up. But the critical question would be that whether they will change the 9 to 12 month ahead inflation forecast number or not, particularly because this quarter next year would have this in the base, and it could mean a significant drop in inflation as well.
You referred that core inflation is softening. Yes, from January 6.2 or thereabouts, it's come down to 5. But Soumya, now fuel has started rising. It looks like global commodity prices are kind of ebbing out or bottoming out. Do you think we will have the core inflation fall for any bit longer? Should we worry about inflation more generally?
Yeah, no, I think Latha, just taking from Shamiran's point of view, I think we now have a paradoxical situation of mind. All this through we have been talking about a sticky core, and the gap between the core and the headline inflation this month could be as much as 150 basis points, if not more than that. In the past also we have seen that 150–170 basis points has been the gap. But the larger question is that whether the core could be sustained at that level. I think below 5 is difficult to sustain, but possibly given the current trends in core inflation, I think it's possible that the core is sustained below 5.5%. And the other important point is that food prices, of course, are a point of worry, but the larger question is that there has been studies in India and which says that headline converges towards core. So if that is the case, and that has happened in the past also, so even if core stays below say 5.5, so headline inflation, which actually excluding vegetables is running at around 5.2% for the last couple of months, I think if that is the trend, we should not worry too much as of now, even though the inflation numbers for the next 2 months could be a little bit ugly.
Okay. I'm still, looking at growth numbers globally, which seem to be surprising on the upside, at least in the US. So, Sajid, if you can just give us the global elements that RBI would watch.
Sure, Latha. This is a theme we've been discussing for 6 months now, right? And the point I've been making repeatedly is this time has been different globally because there's an element of global resilience that hasn't been fully appreciated. Both the fact that balance sheets in the private sector are much stronger, households and corporates, and the fact that everybody focused in 2023 on the rate hikes. What they missed out was there was another thing happening. The adverse supply shocks from previous years were unwinding, and that was helping growth and disinflationary. Bottom line is that I think there are three things to watch globally. One is more resilience. First half global growth is tracking 2.7%, above trend. That resilience is showing up in growth, it's showing up in labor markets. That has meant that markets have begun to price out a near-term recession and the rate cuts that come with it. One of the reasons why the US 10-year was at 4% even a month ago, much before the whole Fitch episode, right? Number two, you're seeing that the lack of a near-term recession prospect means commodities are inching up. Oil is now back at $85 a barrel. So the first thing will be on rates and commodities, but there are two important other elements to keep in mind. A sectoral shift where you're getting services may slow, but we may go back to manufacturing picking up in the second half of the year. There's a restocking cycle underway. Tech has bottomed out. Final goods consumption is holding up. And so if you see that rotation, again, away from services and towards goods, that may put a floor on the global goods disinflation. In fact, you may get a little bit more goods inflation later in the year. Okay. The third element and the final one is US exceptionalism. We're seeing Europe is disappointing, China has disappointed, but the US is holding up. And all else equal, that means a stronger dollar, which we've begun to see the last few weeks. And a stronger dollar, therefore, puts some pressure on emerging market currencies. So there are these three things going on. Commodities may be slightly higher. Interest rates around the world may be higher. Central banks higher for longer. The dollar may strengthen a little bit because of US exceptionalism. And there's a flaw on the goods disinflation because of the sector rotation back from services to goods.
Okay. Sonal, a similar question to you. Are the global impulses actually likely to keep the Reserve Bank more cautious and hawkish and not dovish? What are your thoughts?
I think as things stand today, there have been two, I would say, like main developments and still progressing. One is, as Sajid was mentioning, in terms of US resilience. And one thing that stands out is the current narrative of soft landing or no landing, because this to us is not a steady state. Either growth is so resilient, as Sajid mentioned, that there's going to be a reacceleration of inflation and therefore Fed needs to do more, or we will finally see the transmission play out and labor market weakens and growth slows down. So in our mind, one of these two scenarios is going to play out. Near term, it does look like disinflation should sustain, but over the next 6 to 9 months, we actually think that the lags will play out and the credit standards are tightening, as we've seen with the senior loan officers survey. So that spills over into business investment and eventually into the labor market. So our view is the US exceptionalism is not going to last for very long. So that is one. I think that's, from a central bank's perspective, given the uncertainty, central bank needs to be prepared for either of the scenarios. Okay. And second is on China, we are hearing a lot more in terms of stimulus measures for consumption, property, infrastructure. We've seen some measures, I would say not enough to convincingly say that the investment and property cycle will turn around. Of course, if it does, then this would permanently put a lid on commodity prices in terms of flow. No. If not, then there's also a risk that commodity rise may not sustain. So I think there's tremendous amount of uncertainty right now in terms of the direction of global macro. And in that environment, from a policy perspective, whether it's the forward view on growth or the forward view on inflation, I think we need to be prepared for all scenarios right now.
Okay. So more likely the RBI will stay pat because you don't know which way things are shaping up. But those questions later. Dr. Sen, if you can put all this together, are you convinced that growth is a little stronger than expected and inflation a little higher than expected? What should the Reserve Bank and the MPC convey, hawkish or dovish?
Well, I think there'd have to be a lot more nuance than that. And, as I think everybody has really said, there is a lot of uncertainty. There have been upside surprises, but the vulnerabilities of the global economy continue to exist, and we don't know how they're going to play out. But as things stand, the RBI really is facing two challenges which they're going to have to deal with. The first, of course, the obvious one is the vegetable prices. And the question is, to what extent will this actually sort of influence inflationary expectations in the country? That's one clear one. The other one is the uncertainty that's going to be around the exchange rate. At the moment, the trends seem to indicate that the exchange rate will continue to weaken, which means that there's going to be an upward pressure on inflation from the external side, despite, regardless of what is happening to global prices. So these two, I think, are going to be there at the top of their minds. Now, there are, of course, upside surprises that can happen, but that is something that the RBI can react to if and when it happens. So at the moment, if I were them, I would play it very, very cautious.
Cautious, I would assume that that would mean somewhat status quoist. In fact, that's the feeling I get from most of the people I talk. Better not do anything. So what we have to really concentrate on, how will they sound? Will they sound hawkish or dovish? Those questions after the break. Welcome back. We have been speaking to the Citizens Monetary Policy Committee members of CNBC TV18. With us, Chairman Pranab Sen, Chairman of our MPC, and members Sonal Verma, Shamiran Chakrabarti, Swami Karthik Ghosh, and Sajid Chinoy. Gentlemen and Sonal, thank you for your patience. Well, before going to the break, it looked very clear from what you are saying that there are enough factors on both sides. So much will depend on which way the RBI tilts in its tone. Shamiran, what's your sense?
Well, I think this is a classic policy where it's very difficult for RBI to give a definitive bias. They will have to play to both sides, while they have to acknowledge that this is primarily a vegetable price inflation which can be looked through. In fact, that could
He says that it is dovish.
It need not be if it is also along with a comment that they're still very clear about reaching that 4% target, and the last mile of that disinflation process is the most difficult one. Or they could skip the look-through part and just demonstrate that through the 9 to 12 month ahead inflation forecast remaining close to where the earlier forecasts were, just to show that this is a more temporary increase in prices. But it is one of those policies where it's difficult to take a side, and rather it's better to do a tightrope walk and play to both sides.
So you would say as RBI is likely to be as neutral as possible in the tone?
I think so. I think this is a time where both the doves and the hawks should get something.
Okay. What are the chances, Sajid, that the hawks get more?
So the word I would use is not hawkish or dovish. The word I would use is vigilant, right? And I would say vigilance because till about 3 months ago, there was a belief that we were in a bit of a sweet spot. Growth was surprising to the upside. Inflation was to the downside. Now those inflation risks have all turned. And I would say there are 3 categories of risk. One is the vegetable part, which clearly is a transient supply shock. You should look through that. It can be sharp, but hopefully short. But for me, there are 2 other more enduring risks. One is the monsoon. So far, we've been lucky, fingers crossed, the monsoon has been fine. But the El Nino concerns are supposed to develop later this year. And that could have an impact both on Kharif, but more importantly on Rabi because of water levels. So that's one more durable food inflation risk. And the second is what we said about global commodities, that a lot of India's core inflation, in fact, almost all of our core inflation last year, the acceleration was global goods inflation. Now, global goods have disinflated, India's core has come off, right? Do you get continued benefit from that? Or later in this year, if you do get this rotation back to manufacturing, crude goes up, something happens in China, commodities go up, and that puts pressure on core. Not to be alarmist, these are things down the road. They will take comfort from the fact that core inflation is heading towards 5 for now. But given these risks, vegetables now, food later, commodities possibly down the line, the word I'd use is vigilant. I'd be very focused on keeping that 4% narrative going, medium-term target of 4%, and on inflation expectations. I think they were right to point that out in the last meeting. and inflation expectations get tested when you get long food price shocks.
Absolutely. So my sense is if Samiran is neutral, you're 1 standard deviation or 0.5 standard deviation, more hawkish, to the right. Soumya, we didn't discuss liquidity. Is there nothing much that the Reserve Bank will communicate on liquidity? One factor which a lot of bond dealers tell us is that this liquidity surplus 2.5 lakh crore is not really that much because of this nest 24 hours the cash is needed to settle. Actually 1 lakh crore is needed for that. So are you expecting him to say anything on liquidity?
No, I think so far the Reserve Bank has done a fine balancing act on liquidity. The issue also has been the significant capital inflows, so foreign exchange reserves buffering up. But beyond the point, I think the point you mentioned is actually very interesting point. And what happens is that currently, if you look into the liquidity, around 3.8 trillion is the overall durable liquidity. Government cash balance is around 1.7 to 1.8 trillion. So the systemic liquidity is around 1.9 trillion. Now, out of that, the general perception in the market is that a large part of that, maybe around 70,000 crores, which is basically 0.7 trillion, is actually being used up by the system in terms of a precautionary motive because of this 24/7.
Precautionary liquidity.
So that means that if you take out that 80,000 crore, the total liquidity actually comes to 1 trillion, and when against the RBI mandate of around 2.5 to 3 trillion. So in that case, we are actually running a liquidity which is almost neutral. So that begs the question of which we have been raising for the last several meetings in terms of change in stance. But here also there is, I'll just take 1 second, there is another very interesting paper by the Reserve Bank saying that beyond 5.5%, any guidance looks very difficult to say, and beyond 6.5%, all guidance actually has no impact on the market. So if we take that as the benchmark also, which is obviously the second point which will address, is basically the stance also will remain the same because there is no impact in terms of on the market, because market is aligned to the expectations that the RBI has built up.
Okay. Well, in that case, tell me, Sonal, what will you watch out for from the policy?
I think one is in terms of the durability of the food shock that the RBI thinks
what is their assessment?
Whether it's going to impact only the September quarter number average, which they have a 5.2, the upward revision for the full year is largely on the back of that quarter. And the forthcoming quarters after that, the view right now we have is that they'll keep it unchanged. So it's a 1 quarter transitory shock. So I think whether that is their assessment or this spills over into greater than 1 quarter, in which case I think so that would be a signal. So that in turn has an implication on the average forecast for the year. So if it is just a quarter shock, then we think the revision will be from 5.1 to 5.3.
So you will watch out for the inflation revision?
The durability, of course, but the underlying assumption here is the durability of the food inflation shock. I think second and the biggest challenge for the RBI starts now, which is that we've had this shock. We've had a great deceleration on core momentum actually in the last 3-4 months. Whether that continues in the next 2-3 months and the next round of household inflation expectations, whether that shows that expectations have remained in check despite the food shock or not. So I think these spillover effects become quite important.
Okay.
And the final thing on growth, I think the headline growth, of course, has been holding up. But underneath the details, for instance, the exports goods slowdown is translating into services export slowdown. The consumer numbers are not that great. And corporate results also, where you had weak sales, profitability holding up, you're now seeing even profits come down. So essentially, it's largely an investment-driven growth that we are seeing right now. So, of course, aggregates are great, but I think the commentary around the, the consumption and other metrics, I think, will also be important.
Yeah, I'm sure there are data on both sides in terms of growth. What would you say, Dr. Sen? Do you think the Reserve Bank would fear at all that inflation can become generalized? I mean, I'm moving away from growth to inflation. It is food now. Will they have the fear that it can get generalized?
Interestingly, the one thing we haven't talked about is the trajectory of what's happening to our fiscal numbers, right? One of the big surprises that came out was that in the first quarter of this year, the government spent 25% of what was budgeted. I don't know if people realize how extraordinary this is and what the implications are. Usually in the first quarter, the government spends somewhere between 35 and 40% of the budgeted. Second, third quarters, everything goes into doldrums, and then it picks up in the last quarter. Now, a 25% spend in the first quarter, to me implies, and I'm sure some of the MPC members will be picking this up, means that the government is reserving its ammunition for period closer to the inflation. Whether that's going to be in the second quarter or the third quarter is tough to say, but it's coming. And you are likely to see a certain degree of fiscal adventurism going on around that point in time. And that's something the RBI will have to keep in mind and make sure that that doesn't upset the apple cart. The second thing that the RBI will need to keep track of in terms of the way they think about the play out of the FIS is that the big difference seems to be the government paying off its liabilities to various suppliers of various kinds, and deferring them. Usually those are deferred to the first quarter and paid out. This time it may well be the case that the payout is going to happen in the second quarter. Right? So all of a sudden you are going to get a fairly sudden injection of funds into the household budgets. And that can again be very unsettling. So frankly, it's not just the food inflation today. It is that we may actually get a sudden injection of expenditure from the FIS, which can actually aggravate the problem. So at the moment, I would hesitate to be really balanced between the hawkish and the dovish. If I was talking, I would tend towards the hawkish, not excessively so, but hint towards.
I mean, definitely the Reserve Bank will have on its mind that there is an election coming and there could be some changes in revenue expenditure and reduction in capex. Certainly that calculation will go in, but it will be interesting to see what they say about it. Time to vote. The first question obviously is what should the MPC do to rates? Sajid?
On hold.
On hold. Saumya?
Pause.
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 Sodan?
Pause.
Dr. Sen?
Pause.
Okay, so it is going to be pause. I think that's not a surprise. Let's see if stance will change at all. Sajid, the stance is, a removal of accommodation. Does that change?
Retain the stance. Withdrawal of accommodation.
Withdrawal of accommodation, sorry.
Stance
Withdrawal.
will remain unchanged.
Okay. Stance?
Yeah, retaining the stance.
Retain withdrawal of accommodation.
Retain.
Okay, retain stance. Dr. Sen?
Neutral with a hawkish bias.
Okay, all right. So there is a 4:1 over there. But I think now, since there is so much uncertainty, I want a very quick third question. When do you expect the first cut?
Too much uncertainty, but I would say early 24 at the earliest.
Okay. Saumya?
There is a lot of uncertainty on the ground, but not this fiscal year. Next.
Not this. So April 24. Samiran?
Same with us, first quarter FY25.
April 24.
We have it in Feb 24.
Feb 24, a little earlier than that. Probably Sajid is hinting at that. Dr. Sen, when do you think, sir?
I think we are unanimous. In probably late
2024.
Yeah, 2024.
But would it be early? February, April, you want to choose?
I would probably think it would be after the budget is presented.
Okay, so February. Then in that case, it's 3:2 in favor of a possible February cut. Thank you very much for watching this special broadcast of the Citizens MPC.